Goldman Sachs just came out with an investment report predicting a 3% rate of return in the stock market over the next 10 years. In today's video, we're going to be talking about why you should care. We're going to be talking about why they came up with this number at 3% and what you can do about it, because more than likely, if you're a stock market investor, you're going to be looking for more than 3% in your investments for the long term. Okay, so first off, why should you care? Banks, investment firms, they make predictions all the time. Should we pay any attention to it? Many times I say you should not really look at these predictions. When it comes to this, the reason, or in this paper in particular, the reason that I think we should pay a little more attention is this is a long-term projection, not a where do we think the market's going to be next year. I think we've seen over and over again that is incredibly difficult, if not impossible, to predict. But when it comes to longer-term projections, many firms using their models can get pretty accurate in terms of longer term projections. So shorter term, incredibly difficult. Longer term, more likely to be successful. Now, Goldman Sachs' model goes back about 100 years, and you can see here, you've got your light blue line, which is the actual modeled return. So based on the numbers they're seeing, where they think the 10-year returns are going to land. And that dark blue line is the actual 10-year returns in the stock market. And as you can see, these numbers are pretty close. And if you extend a little further and you start looking at this dotted lines and shaded area, these are the predicted rates of return for 10 years in the stock market based on the same model that has done a pretty good job looking in the past. Now, you mentioned 3%, or I mentioned 3%, but in reality, what Goldman is giving us is a range, 3% being kind of that middle number. And that range is anywhere between positive 7% over the next 10 years or negative 1% over the next 10 years. And the middle is essentially 3%. Now, negative 1% might not exactly be what you want, and even 7 is probably not what you might be looking for in stocks, in equities over the long haul, right? One is a suboptimal outcome and one is a bit of a disaster at negative 1. And so when you're looking at this, this is saying that within a 95% confidence ratio, which is a fancy way of saying most of the time, right? It's going to land between this range of returns based on what we're seeing in the market. Okay, so as far as circling back to why should we care? Well, these numbers have been pretty accurate in the past, and we should probably be considering this in our plan to make sure we understand what we own here. Now, when we're thinking about, okay, why should we care? The next thing is, why did Goldman Sachs come up with these numbers? Where does 3% come from? Why not a normal rate of return? You know, you hear the stock market, the S&P 500 in particular is what we're discussing, 8 to 10%. Well, the reason, if you read the 37 pages, good news is you don't have to. We're going to talk about it right now. Really comes down to a couple of things. One is the markets are pretty expensive right now. The S&P 500 has higher than normal ratios. In other words, people are paying more than usual for earnings, for cash flow, for the usual stock market metrics that you hear. People are paying more than usual. And all things being equal, if you pay more for an asset or a cash flow, and all else being equal, your expected rate of return in the future goes down, okay? So higher prices, lower expected rate of return. So that's one piece. But the bigger piece that this very large, in-depth report hits on is there's an uncomfortable amount of market concentration in the S&P 500. We've talked about this. You've probably heard about it. There are roughly 7 to 10 stocks that make up a whole lot of the S&P 500 that are all trading at very high prices right now. And historically, whenever you have times like this where certain stocks or a small set of stocks trades at expensive valuations, it usually doesn't spell great news for the long-term investor over the next 7 to 10 years. So that was Goldman's real issue. So you don't have to read the 37 pages. At its core, it's saying stuff's pretty expensive, in particular, these select top stocks. And when you have select top stocks getting expensive, it doesn't look good in the future. And so that's essentially why Goldman is saying it. So as a long-term investor, what can you do about it, right? Well, remember, Goldman is not talking about the entire market. They're talking about the S&P 500, which is the 500 largest companies in the United States, which is even more heavily weighted towards those top 10, top 20 companies. And so what does that mean for an investor? Well, outside of just the largest U.S. companies, you have an entire world to invest in, right? You have fixed income when it comes to other equities. You have smaller companies, mid-sized companies. You have international companies. So there are plenty of other assets to be looking at outside of the S&P 500. Keep in mind, this is not a recommendation, okay? This is just pointing out what our numbers tell us about what the future may look like for certain asset classes and how you can think about it as a long-term investor. I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.